All right, I got my PowerPoint up here. All right, so welcome everyone. My name is Chris Crippen. I'm with inOcean Enterprise. I know that this is the innovation showcase, but we thought we'd take it in a little different direction and talk to you about a trend that's going on in the industry that really doesn't get a lot of attention at these conferences, and kind of wanted to go over it with you today. It's real estate investment funds. And as the REOs start getting transferred from governments and institutions back into the private sector, we believe that this trend will pick up. And I want to talk to you about four different ways really, on how you could participate in it. And really this is just to get you guys thinking about this trend, because we believe that there are going to be a lot of opportunities for agents to service these. How many people in here are agents? All right, good. This is kind of geared toward you guys. So let's keep going. So real estate investment funds. All right. Before we get going and start talking about this, I want to give a disclaimer, because people get excited about real estate investment funds. And even though it is simple, it is really not that easy to get going in an investment fund. I'm not a lawyer. We're not looking to raise money from you for any of the funds that we're involved, so you can relax. If you're going to participate in a real estate fund, you should get the best lawyer that you can get to write the private placement. We'll talk a little bit about that. I'm not a CPA. I'm not giving you any tax advice. It's just me, and this is what I see. All right, so we'll get going. Now, this is a big topic. I only got about 20 minutes to talk to you about this. I just want to kind of peel back the layers so that you can see how real estate investment funds work, how they're structured so that you can service them, how you can participate in them, and how you can even sponsor a fund yourself. And then we'll kind of wrap up and tell you about what it is that inOcean does. So why you should listen to me or my experience. So I started in the real estate industry, the mortgage industry, about 15 years ago. I worked with a national lender, rose up through the ranks, and soon I was managing about 500 brokers across the United States. Thought I could do it better, opened my own lender, had 40 brokers working for me. We were knocking out of the park. I was a big deal. I'm not afraid to tell you that. Just kidding. Not really. I was. Then 2007 came around, and it hit me like a ton of bricks. My friends and I joked that that year in my life was kind of like a country song. I lost my company, I lost my wife, they took my house. If you would have shot my dog, it would have been a country song, right? I'm sure that you all had similar experiences when it came to that. But we're fortunate, or so they say, we're fortunate for our misfortune, and this was a seminal economic event in my life, certainly in the lives of everyone I knew, and in the industry, the only industry that I had known since getting out of college. And I wanted to understand it. I needed to figure out what was going on, because everything just got shook up. I'm sure that you all participated in this. You all look of that age. So I used my banking contacts to get a job at Fannie Mae as an asset manager. And I really learned asset management from Fannie Mae, which I consider to be the gold standard in asset management. And it was there that I got introduced to real estate funds. They were really the only people that were buying the properties. And I managed a portfolio of about 500 homes. And I started looking through the contracts, and it was fund and fund this and fund that and fund this. And they were really the only people that were purchasing the homes, as I said. So I got interested. But as fate would have it, the FDIC came calling in the form of Prescient Asset Management, and they needed somebody to lead. Prescient had just been awarded the FDIC ORE, Asset Disposition contract, and they needed somebody to lead it. They chose me, and so I moved over to the FDIC, and from being curious about what was going on, getting a job at Fannie Mae, now I was sitting at the table at the FDIC with the senior executives designing the disposition systems and processes that the FDIC currently uses today. As a matter of fact, when I was at Prescient, that's where I got involved with inOcean Asset Management. We worked together to develop a unique asset management database platform that is currently used by the FDIC, and we'll talk about it a little bit later because it's unique. Well, I did that for about 2 years. Under my tenure, we closed about 150 banks, and let me just tell you that nobody's happy when a bank goes down. The FDIC doesn't want it to go down. The senior executives certainly don't want it to go down. The employees have no clue. The depositors are certainly stressed. And I was the point man for that. So I did that for about 3 years. Like I said, we closed about 150 banks, disposed of about 23,000 assets during that time. And I kind of got burnt out, right, as you can imagine. At one point, the FDIC had put my cell phone number as the bank contact list for all these failed banks. So everybody that called me, it seemed like, not only that, it was like 2008, 2009, and it was just complete turmoil. So I said, forget it, I'm done. Prescient Asset Management, owned by Eric Toronto and ran by Sam Eigel, always very nice to me. They took care of me. I had a little money in my pocket. Just turned 40 years old. I said, I'm done with real estate. You know, I was due a midlife crisis, so I went off to Europe to go be an artist. I enrolled in art school, and I said, I'm done. This is what I'm going to do for the rest of my life. But as I was over there, I would notice in the cafes that this real estate crisis that was going on in America was a big deal over there also. And I always believed that in crisis, there is opportunity, and I just couldn't shake it. And I had to get back into it, especially since I'd worked so hard to get back into the business, and I was at a decent level that I felt that there was still something for me to do. So I came back to the United States, and as fate would have it, a good friend of mine who I had worked with at Prescient, Al Espinoza, the CEO of inOcean, they had just been awarded the HUD Asset Management, the field services portion of the asset management contract, and we kind of got together. Now, he didn't need an operations guy. We have a brilliant COO, Amos Alexander, Six Sigma black belt, MBA, and so he really didn't need a guy to run it. But Al's a very smart guy, and he said, listen, Chris, with your experience in the industry and your creativity, he goes, I want you to explore other options, to study the trends and see what's going on. As a matter of fact, he had a map, and this is what he wanted to do so that he could expand, use this contract to expand his footprint so that he could better service the REO providers and increase inOcean's footprint. So we got together, and that's kind of how I ended up where I'm at today. And when he said he wanted to explore current trends, I said, we got to do a fund. We got to look into the fund. Funds are the way to go. When I was at the FDIC wasn't necessarily interested in holding properties. They had their main goal is to replenish their insurance fund. And as banks were falling down, they needed as much money as they could. So we explored a lot of alternative disposition strategies when we were at the FDIC. Bulk sales, auctions, Dutch auctions, you name it, we really explored it. And that's really where I got to know the big players in the fund game. And we'd worked with inOcean Enterprises to do a lot of these alternative dispositions, and we'll talk about in a minute. So when he said, Chris, I want you to come on as Director of Business Development, I said, Al, we got to look into the fund. So that's kind of how I got into the fund, and now I want to talk to you, kind of peel back the tarp of how funds work. So before we get going, I want to talk on a real macro scale on what's going on in the economy today. I was at another conference, and I heard the chairman of the Board of Reserves in St. Louis, and he had this diagram up here, and I thought it was really interesting, kind of a macro picture of what's going on. So what happened back in the early 2000s up to about 2007 is that all these private companies wrote a lot of debt with collateral on assets. The bubble burst. Usually what happens when a bubble bursts, the government comes in and they support the assets in the banks, and that's exactly what happened. The GSEs were assumed by the U.S. government. I think it's we're at 539 banks have failed so far, and we've went from private to public assumption of assets. That's what happened from 2008 to 2010, and it's still happening currently. And now we're in the second phase. The U.S. government isn't in the business of holding assets, so they're transferring them back down to the private sector. As a matter of fact, this is the largest transfer of wealth from public to private in the United States, in the history of the United States, and probably in the world. But this is the space that we wanted to be in. This is the trend that we study, or that I study in business development with inOcean. And as this picks up, it's only going to get bigger, right? We just got through We just got through the whole debacle with the robo-signing, kind of got a delay there. Fannie Mae, Freddie Mac, FHFA says that they're going to start dissolving that. So this will keep picking up. And as this picks up, this guy or guys like this are just going to get bigger and bigger. I'm sure that in each and every one of your marketplace, on your newspapers, in the real estate sections, they talk about fund guys. I live in South Florida. This guy raised $40 million. The average size of a fund is about $5 million. And we believe that it's just going to start picking up. And this is the most interesting trend that I study, or at least the one that I'm the most passionate about. And so we study how can we service these guys. So this guy here, he raised $40 million and he buys bank assets in South Florida. So like I said, there'll be more and more of these guys. And you can actually participate and sponsor a fund yourself. I can tell you from my experience with funds, what's needed most or what's the most difficult part of a fund is deal flow. It's finding opportunities in the local market. That's what's needed. So if you're a real estate agent, there's an opportunity there. We'll talk about it in a second. So what is a fund? So I pulled this off the internet. It's a sophisticated investment structure allowing groups of like-minded investors to purchase, control, and profit from lucrative investments. It's a definition of a fund. So that kind of sounds like a security, but there's an exemption in the law called Regulation D. And that's kind of what all these fund guys work for Regulation D, exemption. 506 is the most common. We're not going to get too in detail. If you want to stop by my booth 121, we can talk about fund dynamics all day long. But Regulation D was put in place so that smaller companies could raise capital without having the expenditure of having to file with the SEC and go through the whole Facebook kind of capital raise. So this is what funds are all about, or basically the textbook definition of a fund. All right? So what's a typical investor? Who invests in the fund? So we have a fund, so where do they get their money from? Well, a typical investor that we see is predominantly 50 years or older, usually experienced investors, and they're always looking for investment options. And I would say that as the economic crisis worsens around the world, that real estate in America is only going to get more and more attractive, not only for Americans, but others around the world, especially at current market rates. More importantly, an investor for a fund, a Reg D 506 fund, you have to work with accredited investors. An accredited investor, so this just changed, by the way. Like I said, I'm not a lawyer, and if you're going to start a fund, we can talk. But basically, they have an income of about $200,000 per year, joint income of about $300,000, and have a net worth exceeding $1 million. That's kind of the profile of the people who are investing in these funds. Like I said, I'm trying to give you a dynamic of what a promoter does, who's investing in the funds, and we'll talk a little bit so that you can kind of understand it, so that as you identify them, you can work with them and generate more business and more fee income for you. Or what hopefully I can do is kind of encourage you to explore starting your own fund and passing that opportunity along to people that you work with as well. I think that as much capital as we can get into the system to purchase these distressed assets, the better off we're all going to be, so that we can get this pig in the python through, so that we can get on with the American experience, right? All right, so why do people invest in funds? Why wouldn't somebody just go out and buy a home? And they do. I got to be honest, the number one person that would invest in a real estate fund would be someone who is currently investing in the real estate market. But why would somebody want to invest in a fund? Obviously, they're accredited investors. They do well. People participate in funds so that they can participate in real estate opportunities otherwise unavailable to them. So when my tenure at the FDIC at Precedent Asset Management, we would put together bulk sale funds of 50, 100 properties, and they would sell for $2, $3 million a pop. And they would have a significant discount on them, but if you didn't have $2 or $3 million cash, there's no leverage when it comes to buying these bulk sales. If you didn't have $2 or $3 million cash, you just really couldn't participate in this. So the number one reason why people participate in funds is so they can participate in opportunities that they would otherwise not be able to participate in. I guess I should say the number one reason is the potential for high returns, right? And I believe that if you can purchase properties at current market rate, the average fund has a hold time of about 5 years, that if you can purchase them at a current market rate with a little bit of a discount, maybe at 80% of current market value, 90%, typically the bigger the fund, the less spread or the less discount they need on the acquisition. But I believe that if you hold them and carry them for 5 years, which is the average hold time, I believe that the returns that are going to be available are just going to be more than what people think now. So people invest in funds for the potential of high returns. Last but not least, and I shouldn't say last but not least, there are all types of reasons why people invest, but a major reason is risk mitigation. So if I had $50,000, I wanted to buy a couple units in a share of a fund, and I wanted to buy a property. If that property didn't quite work out and I put all my money into that property, it goes under, I'm done, right? But if I can invest in a fund of $5 million and I have 2 shares and there are 100 shares in it, then I can buy 50 properties, or the fund can buy 50 properties. So if 2, 3, 4 properties fail, it's not a big deal, right? So risk and mitigation is another reason why people invest in funds, all right? So what kind of properties are funds looking for? So I talk about funds a lot with people. It's kind of a passionate subject with me. I meet with a lot of fund guys too, but fund guys. And they always ask, well, you know, we can't find properties that funds would want. They need really steep discounts. And I pulled this from one of the private placements of a fund that we're looking at. And as you can see, this is a typical metrics of a property. Get in, you purchase a property about $56,000. A few rehab repairs. You're looking at about 80, 85% of the current market value is all that you need for a fund to be happy. It needs to be in a decent, so different structures that you can have with a fund. Some are buy cheap and hold. Some are buy cheap, rent out. REO to rental seems to be a big trend that's coming. But so a fund with a discount of about 10, 15% off current market price in a decent, stabilized market with rents, not too difficult to find in any of the markets across America. As a matter of fact, a lot of people are looking to put together funds to buy properties that are going to come on the market. I'm under the assumption, or I believe, that there are current properties on the market that would satisfy any of the funds that we deal with, and they just need local boots on the ground to identify them and present them to the funds. Never syndicate a 6. So we're talking about properties. So you'll identify, hopefully I can stir up enough so that you can get enough interest, so that you can, when you see these fund guys, you can kind of understand the metrics of who's investing and who's looking for the properties, so that you can start looking for properties for them and presenting them for them. One of the rules in fund management is never syndicate a 6. So if we have a scale from 1 to 10, 10 being the best property, 1 being the worst property, you never want to syndicate a 6 or less. You don't want any dogs. The reason why funds are started is for the investor. It has to be a good deal for the investor, right? Nobody's looking to make money or equity stripping off investors. It has to be a good deal. So the rule of thumb is we don't want any dogs, never syndicate a 6. 7, 8, 9s, and 10s are the kind of properties that funds are looking to buy. All right? Moving along. Why set up a fund? So why do people set up a fund? Why would you want to set up a fund, or why would you be interested in set up a fund? The number one reason why you want to set up a fund, I believe, is control. So that if I raise $5 million, now I can control where that $5 million goes. I can identify the properties, and I can hire the local professionals to purchase the properties, acquisition fees, disposition fees. I can control who does the property management on these fees. I can control who does the rehab on these fees, or I'm sorry, on these properties. And I can choose to do these services, and I can earn the fees so long as it's at a competitive market rate. So the number one reason why a fund promoter starts a fund is for control, so that they can identify the properties and they can get the broker fees, they can get the rehab fees, they can get the property management fees. And then last but not least is equity participation. So if you start a fund, most funds require that the promoter invest in the fund. Doesn't have to be a little bit. Maybe they just want to see, investors like to see that you have a little bit of skin in the game. But once you're the promoter, you have a hold time, then you can participate. Once you dispose of the properties, you can participate in the equity participation, which I believe properties purchased at current market value with a little bit of discount to mitigate any kind of downturn. I believe in a 5-year time frame that most markets in the United States are going to come out. Granted, there are exceptions, but I believe in a 5-year time frame, markets are going to experience some sort of appreciation. All right, so we talked about controlling and the potential fees that could be associated with a fund. Here are some of them. Acquisition. So when a property is purchased, it's typically purchased through a real estate agent. If you are the promoter of the fund, you can determine, or you can be the buyer's agent for that fund, so you can get 3 to 6% on the front end. Property management fees. You can, so long as you manage the properties, you can charge a property management fee. Asset management fees. Typically the way a promoter or a syndicator of the fund works is that they manage the assets of that fund and they charge a 3% fee after a preferred return of 8% given to the investors in the fund on an annual basis paid out quarterly. After that, they charge an asset management fee of typically 3%, and then any income over that is usually split 50-50. Next, equity participation. Typically, when the properties are sold, the split is 60-40, so that 60%, after all capital and all fees that were associated in starting the fund, after that is returned to the investors, typically it's split, any equity over and above capital is returned, it's split 60-40 between investors and the promoter. And last but not least, disposition fees. When the property is sold, there is a fee that is produced for a broker. So long as you're a licensed broker, you can get that as well. So there's a lot of opportunity to sponsor funds and promote funds. All right, typical fund size. The average fund size is about $5 million, 55 to 70 properties, 5-year hold time, right? On a 5-year fund, you got to, once you raise the money, you got to put it to work. So you need to be able to identify about 50, depends on your market and what your strategy is. All funds are different. But you've got to be able to put that money to work in about a 6 to 12 month time frame, buying the properties, rehabbing the properties, renting them out. You could probably do it a little bit longer, but 6 to 12 months. But once you've got that portfolio stabilized, it's really just property management for the 5 years. A typical $5 million fund generates about $250,000 in management fees per year, right? So that's about market average for it. So there's a lot of opportunity for people to promote funds, both in fee income and equity participation. All right. So what does it take? What kind of skills does it take to set up a fund? There are basically 4 critical skills that are needed to set up a fund. Number 1, market skills. I would argue that this is the most critical skills. This is local knowledge, boots on the ground. Every fund manager that I've ever talked with or deal with, it's deal flow that is the biggest challenge. It's identifying the properties that meet the metrics for the fund. So market skills, capital skills, dealing with investors, working with investors, asset management skills, managing the properties, managing the portfolio, and business management skills. So private placement is the mechanism by which you start a fund. This is nothing new. It's been used for years on the commercial side. It's used for years on the venture capital side and on the angel investing side. It's just kind of new coming over to the residential side. So it's really just a business. Here's our business plan. Here's what we plan on doing. Here are the properties that we're looking to do, and here are the expected returns. So business management skills are critical. So not too complicated. Here's the thing, is that you can partner with others. If you don't have these 4 critical skills, you can partner with others to make up where you are lacking. That's kind of peeling back on a real basic overview on kind of how funds are set up. You have a promoter, syndicator, general partner. Investors are the limited partner. They invest, and then you implement the money, need a decent return, hold it for 5 or however many years, and then sell it out. And that's kind of the trend that we were exploring, that we think is only going to get bigger as the properties get transferred from public to private. And so what I want to talk to you about now are some of the inOcean services that we created to assist this marketplace. right? So we saw that this was coming, and we currently manage about 10,000 properties for government agencies, institutions, and other portfolio owners. And we wanted to kind of create a group of services that we could assist funds and other institutions. So we came up with acquisition to disposition and everything in between. So acquisition to disposition. So if I own a portfolio, there are a lot of great asset management companies out there. We're a great asset management company, field services company. But if I'm looking for the fun part and I need someone to help me identify properties or value properties, typically as a portfolio or as an asset manager or a portfolio manager like I've done in my career, I'd have to go out and find this guy to do the asset management, this guy to do the acquisition, this guy to do the valuation. And we just wanted one complete suite of services, which is acquisition to disposition and everything in between. All right? Next, I want to talk a little bit about some of the services that we're working on and that I'm developing. And really, I'm going to kind of blow through these so that I can get to the more exciting beta stuff that I'm testing. So we do alternative disposition. inOcean started as an IT company and moved into asset management, worked with us at the FDIC, Prescient Asset Management, was awarded the HUD contract, and has really evolved into a full-service national big player in the asset management piece, but they still have that legacy IT. So as a business development director, I get to play with all these pieces. I get to play with the IT department, I get to play with the asset management department, and one of the creative areas that we're in, or that we have, is alternative disposition. Bulk sales, auctions, Dutch auctions, all high-tech, all web-based. So just want to kind of throw that out there. You can stop by my booth. I think I'm running out of time, so I'll move a little bit forward. Next, we have an innovative asset management database software that was developed for the FDIC, like I said, was currently in use by the FDIC, and it's different than the asset management software programs that are on the market in that it's completely customizable. A lot of the asset management software programs that are out there today are one size fits all, but this one is completely customizable for your process and for your process, completely customizable. It's cloud-based, it's integrated with a real estate sales website, so as the asset manager, so there's a little bit of a disconnect in asset management. So asset managers work on the portfolio, then they send it to a real estate agent, and then the real estate agent markets and disposes of that property, markets and sells the property for them. Well, our asset management database allows the asset manager to work on the property and then show up in real time on our real estate sales website. Also, this asset management database has an alternative disposition capability, and I don't know any other program that has it, meaning that you can have your portfolio in front of you, you can select properties that are in your portfolio that you want to identify or select for some kind of alternative disposition, whether it's bulk, whether it's auction, and then it'll take all those documents and put it in a web-based platform, and then you can have the alternative disposition site that then investors and others can use. All right, so we're wrapping up some of the beta things that we're working on. So there are a few things that are happening in the marketplace today with the Jobs Act that just passed, crowdfunding. We've got a pitch page. The pitch page is the only crowdfunding site for real estate investments. It's beta, jobs funding right now. The Job Funding Act is kind of an exception for unaccredited investors to participate in the funding of startups. We're developing a page for the real estate. It's still in beta. Also, being in the mortgage industry, we work with a top consultant to develop products to service innovative mortgage products, working with a consultant and a coach to work with REO asset managers for mortgage brokers to identify and work with REO agents to assist them with the financing. We also partnered with Sagamore Home Mortgage to present unique solutions for the REO industry. One of the biggest challenges as an REO broker is mortgage products. I know as an asset manager and an REO broker, you got a cash offer or a finance offer. I'll take the cash offer all the time. We're working with Sagamore to develop mortgage products and solutions to circumvent that or to solve that. Anyways, that's about all I have. It's a big topic. I want you guys to get excited about funds. It's going to be the trend going forward. I know that FHFA just announced that Fannie Mae is starting to explore REO to rental, and I think that we'll see a lot more of that as these government agencies and banks and institutions start unloading their properties. So I just want to kind of get you excited so that you can understand kind of what these are doing. I want you to know that you have the ability to start a fund yourself if you're an REO agent or you have local expertise that's desperately needed. But that's pretty much all I have. They're telling me to wrap up. So I was going to do some questions. I don't have time now. So if you want to come by booth 121, I'll be happy to talk to you about funds, inOcean, all of our services and products for mortgages and for REO brokers. But that's all I've got. Thank you very much for your time, and have a great day.